My name is Sverre Tornes. I'm Group CEO at KLP, and it's a great pleasure to welcome you all to this important dialogue meeting in Oslo. KLP has a long history as a responsible investor and owner, and the overall goal of our corporate responsibility activities is to make an effort to contribute to a better world.
The topic for this meeting is certainly of relevance for politicians, regulators, representatives of the capital markets, and many others. I would therefore like to praise Kommunallandspensjonskasse and Publish What You Pay for organizing this dialogue meeting. The Norwegian government is positive to rules that could increase transparency regarding money flows from multinational companies to foreign governments. By requiring multinational companies to break down their accounts to the countries where they operate, the civil society could more effectively hold governments accountable and thereby make sure that the entire population will profit from the revenues.
Now, interestingly, the question of total financial flows affecting developing countries has never been put on the table. We have never examined the question of total money into developing countries, total money out of developing countries, and what's left over for developing countries. This basic consideration has never been examined by the World Bank or by other development agencies. In Global Financial Integrity, we estimate that at $1.2 trillion a year. That's the data for 2008, the latest year for which we have information. Across a period of years, this has accumulated to trillions of dollars that have been shifted out of developing countries. We regard the illicit flow, the tax evading flow of money out of developing countries as the most damaging economic condition hurting the global poor. It drains hard currency reserves, heightens inflation, reduces tax collection, cancels investment, and undermines trade. It contributes to poverty and inequality and leads to insecurity and instability.
So I'm the director of the U.S. chapter of Publish What You Pay, which, as a quick reminder, it's a global coalition founded in 2002. We've got about 600 NGOs working in over almost 70 countries. And our goal, the reason why we were launched, was mandatory reporting in the extractive industries, really, as our name says, getting companies to publish what they pay to governments. Quite a narrow ask, and that ask has evolved over time. So the payments that should be reported, as you know, it's payments by country and by project, and it covers, specifically the legislation covers taxes, royalties, fees, production entitlements, and bonuses. Those are specifically included within the legislation. And then the SEC has some discretion on defining other payments in line with the ITI and part of what's called the commonly recognized revenue stream. Again, it needs to interpret that term as well. What's next? For us, we're getting ready to see these reports come out. Because of the delay, it could be the reports could come out, I think the earliest we're going to see them is 2013 at the very earliest. What we want to try to do as a coalition, and we're stepping back to think about how we do this, is to begin to fill EITI gaps, the countries that aren't covered. How can we use this information to get countries to join the ITI and establish the groundwork for more transparency in countries that may not ever sign up? Libya, Cambodia, Burma, etc. And thereby strengthening EITI in countries that have implemented the standard. And then promote a global standard with Dodd-Frank as a minimum.
Lacking transparency has devastating consequences. I think we all agree on that. And it's not tolerable that resource-rich countries continue to be poor. And also what we see is that the lack of transparency is shaping inequalities in developing countries. So we believe that financial transparency matters mainly for three reasons. So the first one would be to enhance government accountability, to address corruption in resource-rich countries, to improve good governance. And I'm not going to go into the details of that. second point, we think it's that it can matter also for domestic resource mobilization in developing countries. We believe that domestic resource mobilization is as important, or even more important than aid. It's much more important than aid because it's the most sustainable way to fund public policies. And we believe that multinational companies are among the most important taxpayers in developing countries, and that it's absolutely crucial that developing countries unleash the full potential of revenues from multinational companies, and that we help them to address international issues such as tax avoidance and tax evasion.
EuroCIF is a CIF of CIFs. A CIF is a Sustainable Investment Forum. It's always a multi-stakeholder coalition. So it's called a coalition of NGOs, of the financial sector, and of consultants, for instance, service providers, etc. Now, the activities you see, one of the main activities, of course, is also to work with the European Commission, giving input to some of the processes that are being prepared, some of the legislation that's being prepared. But we also do separate research. I'll show you some of it in a second on, let's say, the growth of the sustainable investment market. These are our members. Among them, you will find, for instance, Calvert, that has been mentioned. But my main slide I want to talk to you is this one. Actually, to think about why was this, let's say, the financial crisis that caused the economic crisis, of course. What were the main reasons? Well, there have been many people that have been writing about this, and most of them are a lot wiser than I am. So I would like to share anyway my thoughts about this. I think the main thing is short-termism. And unfortunately, like with the tax avoidance, this is in the heart of all companies. Most companies are being rewarded, most management is being rewarded for a total shareholder return.
In terms of the subject at hand, I think Norwegians understand full well the value of transparency, that the availability of public information is essential for a successful state, essential for efficient markets. There are cases where countries have been exporting massive amounts of gold and other valuable minerals and receiving virtually no tax revenue whatsoever. And that's because of the reporting system and the governance of the extractive sector in that country, and externally from the home regulators allow companies to manipulate their operations through transfer pricing and misreporting and inflating costs and so on to avoid any use of tax havens, which are rampant around the world, to manipulate the books so they don't pay any tax. It would be extremely valuable and very important for Norway to lead the way. Developing countries look to Norway. They don't look to the US as an example. They don't look to the Netherlands as an example of successful oil sector management. They look to Norway. And Norway's Oil for Development program, I think, has been one of the most innovative foreign aid technical assistance programs undertaken by any country. Norway has enormous credibility in the developing world. And if Norway sets a standard and adopts a new law, and is outspoken in its leadership and active with emerging market economies, that will have an influence on their thinking and on their approach to these issues.
The 4th April this year, PWYP Norway presented a legal report explaining how Norway easily could implement a similar Dodd-Frank legislation in Norway relating to payments that could open up to further regulations. We suggested that the requirement for a country-by-country reporting should be incorporated in the Security Tradings Act. We said while Dodd-Frank is important and necessary, Norway needs to go further. So the report that you can see here today, we called it for defining elements because these elements are defining if we are going to see any development. So the report we presented today needed to have done the groundwork first. We needed to look into the Dodd-Frank and to see how it can open up to further regulation. Therefore, in the last report, in defining elements, we have adjusted a suggestion on the law wording so that it may include the elements we think should be subject to regulations. So against this background, we are of the opinion that one way of regulating the elements we proposed would be to incorporate a reporting requirement as a new subparagraph in Security and Trading Acts, paragraph 5.5. But we adjusted the proposal slightly so that it's saying information related to payments should be provided, and not only information about the payments themselves. This wording is, however, in accordance with the corresponding provision in Dodd-Frank in section 13Q2A. And also, it's in line with the EITI and what we already have amended in Norwegian law related to the EITI process. The main differences, how we go beyond Dodd-Frank in this report, is that it's moving from payment data and disclosure data to accounting data. It's possible to track change over time. It shifts the focus from citizens in host countries to a wider audience, and it shifts the focus from exposing corruption in a host country to including showing extent of use of tax havens. It shifts the focus from what is being reported to what is not being reported. It also shifted the risk from investors and from governments and from citizens to the companies taking those risks. It also shifts focus from host country focus to context focus. And also we're moving from the divide between them and us to us. And this will support the EITI by giving reconcilable and audited information on a company-by-company basis.
I have a sneaking suspicion that when we get country-by-country reporting, as I'd like it, we won't discover as much transfer mispricing as Raymond thinks there is in the world. That's not to say it isn't there now. I think it won't be there when we have country-by-country reporting because they won't dare do it. In other words, country-by-country reporting is not neutral. It's not meant to be neutral. It's about changing behavior. We understood a long time ago, physicists understood a long time ago, when you observe something, you change it. We are asking for a lens to be put onto corporate behavior to change it. We don't just want to measure our goals, we actually want to use country-by-country reporting to achieve our goals. I stress that. And of course, it will also change the use of tax havens as a result. My profession, the accounting profession, can deliver country-by-country reporting. I know that all the information that is required to deliver it exists. It must do. Every single transaction of every single company has to be geographically located, and all this individual country data has to be in the consolidation packs of every country. I moved heaven and earth to come here today to tell you that. We can do this. We can deliver this. If we do deliver this, we'll have moved the earth too. It will be in a different, better place. That's why I'd like Norway to take the lead and give us country-by-country reporting. Thank you.